Hello and welcome back to another video. This week in the stock market notched a sixth weekly decline. We have now been down for 1, 2, 3, 4, 5, 6 weeks. And we now have a bear market bounce. We are off by about 4.5% off the weekly lows of 385. And we nearly got to that bear market territory of roughly negative 20%. And that would correspond with the S&P 384. So what we want to know is whether or not this bounce is believable and if it's going to lead to more upside. So again, that's why we have the really happy face here this week, because I think people are ending the week on a high note. Even though we are closing red, it does not feel quite so bad. A key area that I'll be watching for this week includes 403, which corresponds with our gap going back to April 5th. And we've now backtested 400.67, which is the April 2 gap. And now we're looking to reclaim that area. And we're looking to see whether or not we can continue to go higher. 411 and 412 are going to be the most important areas for me this week as well. I'll quickly go through why, and then we're going to come back and go through our normal show. So the reason why 411 is so important to me is because when we look at very high time frame charts, I'm talking about the quarterly chart and the monthly chart, last quarter's low is 410.64. So again, roughly 411. Then we can look here at our monthly chart, and we note that last month's low, or the April low, is 411.21. So what this means is that we need to get back above 412 to what? Get back above the relative low before we're going to attempt to make a new high. So on the quarterly chart, 410.64 comes back to our low set in February. And then 411.21 is going to be that area for us to go back to green on the month. And if this weekly pattern is going to lead to more upside, again, meaning that we're going to get a bounce that's going to continue here. We're getting a lot of really good positive signals. We just need that confirmation. So at a high level, that is the most important thing for this week. I'm encouraged by this bounce, notably that we saw a bounce on the Russell and on ARK, which we'll circle back and talk about a little bit later. But what we have to keep in mind is that when we look here at the last 1 week performance, even though we're closing at the high, a lot of major stocks did not have a great week. We can note that Apple's down by 6.5, Microsoft down by 5, right? Google treading water. Amazon already had its big decline. Tesla down double digits, 11%. Facebook down by 2.5. So the biggest blocks over here are the ones that are the most red. And then as we get to the smaller blocks, it's a lot more scattered where there's no clear trend. So this is not looking all that great because, again, if we look back here to year to date, where are we? Well, we're in bear market territory for Microsoft. Google's off by 0.12%, basically in bear market territory. Facebook down by 40, Tesla down by 27, Amazon down by 32, NVIDIA down by 40, Apple down by 17. So again, not technically in bear market territory this year, but awfully close. And then the theme here is red. We're noticing that as we group this by sector, there's only a few sectors which are actually doing well. And these are defensives, which we would expect to do well in an inflationary environment. I'm talking about energy. I'm talking about utilities. I'm talking about select health and select financials. Why? Hey, you need to drive to work to make your paycheck. You got to make sure your utilities or your power stays on. And you need to get your health care, right? You're like, oh, well, if inflation's high, I'm not going to get my medicine. I don't know. I think people need their medicine. Another way to look at this, and something I'm trying new this week, is just picking out the most important ETFs and DXY and just seeing exactly how they traded this week. So this is going back to roughly April. So again, we're looking to reclaim that April low. And what's very important here is just that we note that DXY has been absolutely crushing it, right? We note that DXY is now up by 6.2% since the beginning of April. In the meantime, we see that the Dow is currently leading, meaning that it's down the least. It's down by 7%, S&P down by 11, QQQ down by roughly 17. So it's very obvious to see that the dollar has been marching higher as these major ETFs have been trending down. So that's important for us to keep in mind. Next thing to look at here is just that we are still at an extreme fear reading. We're coming in here at 12. And this is important because we hit a low of, I think we had a low of 6 this week. So markets generally bottom on fear. However, going into fear does not mean we're going to snap right back out of, from extreme fear right back to fear. Maybe we got to spend a prolonged time inside this area. Not quite sure why the timeline's not loading, but that's something for us to keep in mind. One more quick thing here is just looking at the VIX. And again, the VIX is a Again, not to overcomplicate things, but again, it measures the premium people were willing to pay for options, meaning calls versus puts. And we note that we're now back below 30. And that 30 level is so important because, again, as a rule of thumb, VIX values greater than 30 are generally linked to larger volatility resulting from increased uncertainty, risk, and investors' fear. VIX below 20 generally corresponds to stable, stress-free periods in the market. So what this tells me is that we were inside an extreme fear territory, and we are now coming back down. If we're going to see a bounce, we need to see the VIX holding below 30. That'll be very important for me. Come on, timeline, here we go. So just looking back to here, we note that, again, we went into extreme territory. We hit a low of 7 for a reading. I don't think I've seen anything that low in quite some time. I don't think ever, actually. And here we are, right? Very extreme. We're getting a dead cat bounce. So if the market's going to bottom on fear, we should be getting that happening sometime soon. All right, so the bear market of 2022, where are we and why does it matter? I just walked you through the bear market bounce, which I am personally noticing. Again, that bear market bounce just means that we got within 1 point of getting down to that bear market territory. People started covering, and the highest beta assets are definitely the ones that have been doing well. Meaning this last week, like ARK off the low, and again, a lot of the names that are just associated with that. Orderly decline. Yep, this appears like it is still an orderly decline. If we look at the closing price for the major indexes, again, we're talking about SPY and QQQ. SPY closed out at 401.7. QQQ closed out at 301.9. So they're within 18 cents of the same number. Again, adding $100 for point, adding $100 for SPY. So 401, 301, right? Yep, that's an orderly decline. And why would this be something we have to pay attention to? Well, in a bear market, we're not going to bottom until we start to get an unorderly decline, until something breaks, kind of like Luna. Luna definitely hurt the crypto space this week, and we see Bitcoin below 30K. So this is a quote from, I believe this is Bank of America, and this is what I shared earlier in the week. What it tells us here is that while equities have slumped, paralysis rather than panic best describes investor positioning. This year, said Hartnett, who said for every $100 in equities in the past year or so, only $3 has been redeemed. So that means that people are, they're in paralysis analysis. He also said that January 2021, the average entry point for $1.1 trillion of inflows is 42.74 on S&P. Underwater, but only somewhat. And that level is going to be very important as we look forward to the S&P levels for the week, just because when we look at SPY, that pink line now is going to correspond with that $1.1 trillion in inflows here at about, again, I'm calling it 427.5 just to make it nice and simple, 427.5. And we've seen that as we hit that level twice, we were not able to get above it. Why? Well, people like getting their money back. And that 428 is so important because that is where, for me, we start to get back above these relative lows. What was support or a green line is now turned into resistance. So for us to have a meaningful reversal, and notably here on the quarterly chart, for us to reclaim this base, I'm calling a base here at roughly 428, we need to get back above there, which means that the $1.1 trillion in inflows needs to have a chance to sell and choose not to. One more time. They need to be given a chance to sell and choose not to. Why? Because it's $1.1 trillion. That's a lot of supply. And as we're looking to start to remove more liquidity in the market, we need to be aware of that. Sell in May and go away. Yep. This is definitely a theme that we have to be mindful of, especially with the rate hike path and the rhetoric happening. We also have a slew of Fed talkers this week. And hopefully I got that slide prepared here. I don't know if I actually got it all prepared. I will do it live as we're going through that because I do not want to re-record. So that sell in May and go away is going to become very important as to whether or not we're able to actually get back above green on the month, meaning 412. If we're going to get a sell in May and go away, we are going to reject either at 411 or lower. We're not going to be closing the weekly above that area. It's very important for me that if we're going to have a reversal, that we have to get back above 412 by Friday. We also got OPEX. Nice. All right, looking at where I think we're going to actually land on Friday. I believe that we're going to land at 400 S&P and 300 QQQ. Why? We have monthly expiry, and that is the max pain area. Again, what does that mean? It means we got monthly expiry. Here we can note that I got the S&P or SPY chart, options chain up. And here we're looking at May 20th, which is going to be the monthly expiry coming in 8 days. Here I'm noticing that there is a lot of puts. So first thing I would say is that calls are MIA. There's a little bit of puts at 400 and 405. However, when we look over here on the put side, anything at or above 400 is really max pain. We can note here that at 400, there's 109,000 in open interest and 46,000 in volume from Friday. Down at 395, we got 46,000 in open interest and $20,000 in volume. And we got open interest at 405. So max pain is, again, I think it's going to be actually 400, but 405 might also be an area to look at. Why? Well, they can burn these 45,000 in puts here at 405, which are currently worth $8. And they would have to pay out these puts, which are worth about $8 or the same amount. And there's only about a third of these ones here. So I'm calling it 400, but it could be 405. So again, what does that mean? It means if the bulls are actually in charge, why are they not buying calls? Why are they not excited to be buying this? I don't know. We see those exact same areas starting on Monday. So again, 400 to 405 for the calls, 400 to 395 for the puts. Here's the Wednesday chain, pretty much the same. 400 is max pain, leading through to Friday, which is going to be the monthly expiry. As we look forward to SPY June monthly, this is also very important because we note that 400 here has 85,000 in volume, 85,000 in OI, 17,000 in volume, 36,000 at 395, 22,000 at 405. And again, looking on the call side, they are missing in action. There are no calls, which are notable. So no one's really excited for a continuation play. It looks like they're just trying to avoid us going lower. On QQQ for next week, again, I'm going to go through these really fast just because it's pretty much the same. Here for Monday, this is for Friday. 300 was max pain. Looking to Monday, it's 300. It's the same. 300, 305, 300, 295. Again, it's exactly the same. So I don't want to spend too much time on here because as we look forward to QQQ, May 20th or the monthly expiry, it's almost exactly the same. There's a lot more puts than there are calls, and it's 300 to 305 and 300 to 295. So that tells me that 300 would be max pain. As we look forward to the June expiry as well, it's exactly the same as SPY. We don't really see any calls, right? They're missing in action. And over on the put side, we note that we got 300 with a ton of open interest, nearly 100,000. And then we're actually going down to 290 to find the next sizable chunk in open interest and volume. Yay! So that's very important because I just want to show one more thing here. I forgot to mention this. As I'm looking here at my daily chart for the S&P 500, we are back above the green line, which is that 400.67 gap area. For us to now not just retest the gap, but reclaim the gap high, we're looking at 403.38. For Friday, we hit a high of 403.18, which is awfully close. And as I look here to our daily chart, I'm noticing that we now have a dominant downtrend here. Again, this is more of like mean reversion, spend some time below, spend some time above. Now we're back below. If we're going to make it back to this mean reversion area, or again, what is it? Roughly 410 or that 411 area that we have to take out, it's very important that we first of all have to break the short-term downtrend. And if we're not able to, we're going to be landing where on Friday? Almost exactly 400. So if we go up and come back down or go down and come back up, landing at 400 is going to be a critical area for me on Friday. It is the apex as to whether or not we are going to break the downtrend. So if we are above 400 by Friday, or even just holding 400, we can break the shortest term downtrend here and have potential for us to go back up higher. So there you go. Those are the max pain areas. Now looking forward to our bear market targets of not all necessarily in 2022. We've made some progress. We made it to the 440s. We made it to the 430s. We made it to the 400s. We made it to the 380s, but not quite to 384, which would be a 20% drop off the high. So this is important because as we're looking forward here, we note that the next targets are actually quite a bit lower. They're in the 330s, right? 340s now. These moving averages have moved higher. So again, we got 340s and 330s, right? Yay. Also important to remember that if we're now going to get that bounce back, we note that with funds like ARK, they're getting a sizable bounce just because they're down like 75% off the high. So people are looking for potentially hundreds of percent gains if we're going to be going back up. So if we look back here at ARK and we try to just understand where we were versus where we're coming, again, this is what we showed you last week, where we were talking about how ARK was going to come back down to test roughly 37.5 or puke up its entire move. Again, looking on the right, we have the psychology chart. On the left, we have the actual technical chart. And we hit that target. So let's check in with ARK here briefly. Let's look at our weekly chart. And here we go. Yay, it hit it and it bounced up. Our low is 35.1. So we hit $2 lower than 37.50. And right, we came all the way back up, and it's actually only closing out the week down by 4%. So the big question for me is if we're actually in capitulation, we are now seeing that we're getting that dead cat bounce. Where should we stall out? Well, we should stall out at the first relative low if we're actually going into this extended period here of frustration, starting with panic, going into capitulation, and then turning to anger. So for me, that first relative low is going to come in right here on ARK at about 52. So if we fail to continue to bounce and we cannot reclaim roughly 52, I believe that what we're going to be doing is going into this period here where we get that dead cat bounce. We ultimately go back a little bit lower, and that starts the period of frustration. I believe that most of the decline for ARK is already in because it's already off by 75+% off the highs. We're now down by 78%. As we look forward to these numbers here, that's part of the reason why Cathie Wood is getting inflows, because that 300% looks quite attractive, right? Potentially making 300%. Yep, that seems pretty attractive to me. All right, continuing here. So that's really important because we now have a very clear area here. I can even throw in a line and make it red so that we know that we have to make it back above this area on a close to confirm that this is not just a dead cat bounce. We have to reclaim this relative low at $52. All right, moving forward. Now we have the S&P key areas for the week. So now we're going to understand what levels we need to pay attention to on SPY for the week ahead, the week of May 16th. Again, the market status right now is bearish. Getting back above 412 would get us green on the month. Over 428 would get me back to a kangaroo, meaning that direction is unclear. We're going to get big volatility. And then back above 432 would mean that we're exiting correction territory. And that is where we have potential for a new bull market. In terms of support, again, we're right now at 400, which is going to be that max pain we just talked about. 395 is a psychological area, and then 386 would stage a weekly higher low. In terms of resistance, to the upside, we got that 403. I'm calling it 404, April 2021 gap area. 411 is going to be our February and April lows, and then 415 is going to be the March and April lows. Why bullish and why bearish? So why would we be bullish? Well, value compression. So I'm going to talk about an article here that we got from Goldman Sachs. And here they're talking about actually lowering or slashing the price target to 4,300 by the end of the year, coming down from 4,700. But what I want to look at here is actually going to be the PE compression that they're talking about. In a note, Goldman equity strategist David Costin said, our new baseline forecast assumes no recession and implies the price to earnings ratio ends the year unchanged at 17. A recession would see the index fall by 11% to 3,600 as the PE drops to 15%. Focus on high V low names and growth names. So what does focus on high value, low margin growth stocks. So what this means for me is that he thinks, again, I don't want to get into too much detail in regards to a potential recession this week. I'm going to defer to that a little bit later this week. But what I'm just talking about here is that again, their baseline forecast or their base case is now that we're going to be going down to 4,300 by the end of the year. Previously 4,700. They revised to 2-3 times now. But he's expecting no more value compression. Again, PE is price to earnings. So he would see PE dropping by about 10% more to 15. But he thinks that right now, assuming no recession, we can actually maintain that value compression. So that is the the single catalyst I can see here for the bulls. Tina, nope. Why bearish? 454 impenetrable fortress. Absolutely. We've not been able to get back above 454. As a reminder, that is where our head and shoulders pattern starts. So we have a red line here, which means that is our resistance. And we have a head, we have a shoulder, and a shoulder. And the same pattern is evident on the monthly chart, where we don't actually have a candle closing back above 454, only wicks. And even on the quarterly chart, it's a perfect rejection, right? One candle on the left for the shoulder, two candles for the head, and one shoulder right here on the right. Yay. DXY and TNX breakouts. Let's briefly touch in on those. As we noted at the beginning of the video, DXY is still crushing. It is tearing up. It even got above 105 this week. So if it's going to continue to ascend, I don't see any reason why it's going to stop. With all those Fed speakers this week, it's going to be very important. Recession risk. All right. Yay. U.S. recession is odds within the next year now 30%, survey shows. So we're baking in about a 1/3 chance we're going to be having a recession. There's also a notable change in tone from Jerome Powell. Again, the Fed sure sounds as if it expects a recession. This is from right? I don't want to read the whole thing here. I encourage you to read it on your own if you want to. But what they're talking about here is that, contrast that with comments he made Thursday in an interview on Marketplace Public Radio, where he said, the question whether we can execute a soft landing or not, it may actually depend on factors that we don't control. Again, he's citing things like geopolitical events and supply chain bottlenecks. So Jerome is now doing the pivot, just like he did about transitory, just like he did about we need to get to maximum employment. He is now already starting to do that pivot regarding recession. Please make sure to leave me a comment. What do you think? Are we headed into recession? Yes or no? I do have notes in Slack in the ideas channel as well if you want to see what my thoughts are. I happen to think we are. Tech leading the decline. Absolutely. As we showed at the beginning of the video with the heat map and with the ETFs, tech is definitely leading to the downside. In terms of surprises for this week, we got Jerome Powell speaking on Tuesday. And then we got European Union GDP and CPI numbers coming out on Tuesday and Wednesday. What could this lead? And we also have PPI. I forgot about that. That's coming out on Friday. So what could the surprise here be? It could be stagflation, which is what the Bank of England was talking about last week when they had their press conference. Oh man, I need to actually modify this slide here because I can see that some of the dates are cut off. So please just bear with me for a moment. I'm going to just fix this really fast and then we'll come back here. Sorry for not having this prepared ahead of time, right? Sometimes I make mistakes too. So let me just make sure this all fits on the slide. Let me chunk it down once for size, twice for size to make sure it fits. There we go. All right, all done. Look at that. Justin's fast. All right, so looking here at key dates. These are not going to be bolded for the most important ones. They're just going to be everything here. What does it look like? Oh man, this looks like an important week. Absolutely. We got Fed Williams speaking on Monday. We got European area GDP coming in on Tuesday. That's the same thing we had this week, by the way, for the US. We had GDP, CPI, and PPI. So now we can note that we got Fed Chair Powell speaking on Tuesday. That is going to be the most important data point for the week for me. Bullard, Mester, Evans, all speaking on Tuesday as well. European area CPI coming out. Again, that's inflation. On Wednesday, we also have Fed Hawker. On Friday, we have European PPI. I forgot to put that in. And then we also have monthly OPEX, which is going to be very important, right? That's money. And we got Biden going to Asia. Biden also has a White House meeting on Monday. I don't think it's all that important, though. Moving forward to my base case, Tina is no longer here, right? 454 pivot. It's a bear pivot. Bulls and bears fight for direction. Bears still have the edge. Earnings confirmation. Yes, we're going lower going into May. Not all that great. All right. So now we have the bull case. What do we have to look forward to this week for the bulls other than what we've already talked about? Well, we've got IWM and ARK bounces. Why? If we're going to be going back up, the stocks and the sectors that went down the most should be leading the move back up. So let's have a look here again at the Russell and at ARK. So looking here at the Russell, what's important for me is just that, again, what was resistance going back to 2018 and going back to 2020 is now becoming support. What does that mean? We bounced there. So if the green line is truly going to be support, we should what? Not fall back below it. If we stage a weekly higher low, we can fall back down as low as roughly 169, and that would technically still be okay. If we close below 172 or print a weekly lower low, I think we might be headed down to this gap area here. So this is a nice bounce. If it's going to lead to more, I need to see immediate continuation going into Monday. Why? Because a hammer pattern means that we're actually attempting to go back up. So this move that we're seeing here on the 1 day is going to have to lead to more upside. All right, looking forward to ARK. Already talked about it quite a bit before. Almost exactly the same as the Russell, where we now have off the low, we've now bounced by about 25% from where we are right now. We're looking for roughly an additional 20%. And ARK did that 2-day bounce in basically 2 days. So 2 more days. I don't see why we cannot test this area if that is where we're going to get to. We also note that there is a huge amount of capitulation volume here. So it does correspond with my thesis regarding we're now at capitulation for ARK. Capitulation does not mean a bottom, by the way. Capitulation just means the period of frustration begins. All right, these pesky bears, right? What do they got for us this week? Oh, man, right? Those pesky bears, right? Well, we talked about 400 max pain, and the reason why 400 max pain is important is because they just want to burn the premium before it ultimately goes there into June, if that's the goal. We've hit a lot of our bear market targets, so if we're going to get the next cut, we will reject somewhere in the low 400s, and we are likely going to be headed down to 350, if not lower. We also have to remember that even though we have fear at an extreme reading, the market is still orderly, and we do not see enough stocks below the 200 DMA for us to say that this is now the bottom. There's probably more that are now in that area than before, but not enough quite yet. We also do not see panic setting in. So although there is extreme fear, this is what paralysis rather than panic best describes. $1.1 trillion that has come into the market. That's pretty important. And then again, with those slew of Fed speakers this week, there's like almost everyone talking. So that Fed rhetoric this week is going to be very important. And we've been noticing that the pivot is definitely happening, right? They pivoted on transitory. They pivoted on full employment. Now they're pivoting on recession. Does this Fed have any credibility left? The market's already doing what it needs to, and now they're starting to say, hey, maybe the market is correctly priced. Remembering that Fed rhetoric means that if we start to actually think about we're getting balance sheet runoff starting in June, if we are not able to get to green on the month and start June off strong, what does that mean? Well, we're going to have another bout of quantitative tightening starting on June 1st with that balance sheet runoff starting. So that would be the start of the decline here. Look what happens, right? We just start going down, right? There's the 2018 drop, which led down to our 2020. This balance sheet runoff is only half as fast as what they're expecting to do this time. They want to do it twice as fast as before. What should that do? It should be twice as much pain. And that is where this chart comes from. Again, going back to 1988, the year I was born, to roughly 2020, we went up by about 150 months, 600% gains. That same period from 2020 to where we are now led to 154 months of expansion and roughly 600%. All right, Justin, thank you for the show. Now let's look at some technical charts here and see exactly where we think the market's going to go. I'm going to go through QQQ first, and then we're going to come back and have a look at SPY. And we're going to do a couple more charts just to wrap it up here as well. So I think I'm at about 25, 30 minutes for time. I think I want to get these down to about 20, 30 minutes. And again, make sure to leave me a comment. I'm trying to compress the length of the videos, but not deliver less value. So if you agree with me, again, I encourage you to please just drop a comment. I would appreciate it. On the monthly chart here, we're back above 300 or that key relative low. I'm not sure it's going to hold though. This is going to be very important for us to hold on to going into the second half of the month. Looking at the weekly chart, again, same thing. It's 300. It's so important that we hold on to this. It's a 23% retracement. It's right around those key lows. And there's a ton of volume. So if this is now going to be dip buyers, we can't stall out here. We have to make it up to 315, 316. Which are what? These key relative lows here. We cannot form a new high, which is going to be here at about 330 until we first of all take out these relative lows, right? Going back to February, March, but also to May of last year. That looks pretty important. It does. Also looking here at the daily chart for QQQ, we can note that we're still in a massive channel lower. If you didn't know, the stocks are going down. So we can just note that, again, the funnel lower here is very evident, and this is just a hugely oversold bounce. All right, moving forward to SPY. On SPY, I'm going to look at a very high time frame chart here. This is going to be the quarterly one, and the quarterly chart is clearly broken. Yes, I said that if we're going to get a bull case, and we were only going to get 1 month of contraction, I was looking for 569 on SPY. Based on what? On us only having one negative quarter and then starting to immediately go back up. That's not what we're getting here. we're getting a continuation lower. So now that we got 2 negative quarters, we have to look back in time. And the last times we've had 2 negative contractions in the quarterly chart goes back to 2008 and goes back to 2020. So if this is the start of more, we're not going to get back above that quarterly low. We're not going to get back above the monthly low. And we're going to hang out here for what? More red. Likely a recession, if not more, a depression. Looking at the monthly chart, we can now note that we've now bounced off of the 384 20% drop area, right? It's 385.15 exactly, and still technically bearish because, right, dip buyers came in, we got a huge flush or a washout. Now we have indecision in a bearish pattern. Indecision in a bearish pattern is bearish. And the next stop here, again, would be roughly the 2020 high and roughly the 50 weekly moving average, which also corresponds with that the 50 monthly moving average also corresponds with roughly the 50 weekly moving average, which is going to be our black line here. So this is what the Russell already tested. And that is, again, the 2020 highs here. So 2020 highs is where the Russell is trying to bounce. So if the S&P is not able to go higher from here, I believe that that is where we're going to find our next bounce area. There's a really strong support area here, and I would expect it to hold. Looking at the daily chart, we already talked about it. We got to break this key downtrend by what? Getting back above 410, 411, right? That 411, 412 area just continues to be so important. And then finally, looking here at our hourly chart, we are now back inside the dominant trend, which is going to be the blue funnel. And for us to get bullish, what do we need to do? Got to get back above 405 or take out our relative low here going back to May 2nd. And that also corresponds with that 403 area. If we can get above the short-term downtrend, then we have potential to battle with this longer-term trend, which corresponds with what? Roughly 412. One more note here that I would make is that this hourly volume here on the decline is almost looking very similar to the weekly chart that we had here, where volume starts to drop off and then it flushes in. So if we're going to get a bullish breakout, I would expect to find a continuation in terms of green volume. If we're going to get a washout or a move lower, I would expect to see a breakout of red volume. All right, now we're going to go through a couple more charts just to wrap it up. I'm going to go through these a little bit faster. So again, drop me a comment if you want me to pause on some of these a little bit more. S&P, we already talked about it, right? We hit 20%. We're trying to dead cat bounce, watching 400, watching 412. QQQ, different perspective here. Again, we're now back above the relative low going back to March of 2021 and above our key high. If we can't hold on to that, we're probably going down to that 2020 high area, high of the year. Same thing we're looking at on SPY. That's going to be about 236. DXY breaking bullish, right? We can see that it's now closing back above 2017 and 2019 highs. So that's a breakout. VIX, still bullish, still putting in a cup and handle here. And if it gets back above 30, it means the market's still a little bit scared. If it remains below 30, a little bit more tranquil. TNX, or the 10-year Treasury note, did come down below 3%. And that means that right now the supply zone that we're finding here is between 3 and roughly 3.5%. And that's really important for me to be watching. I'd also note that we're setting up a golden cross here, right? We actually have it confirmed. The 50 MA is now at 1.749. The 200 MA is at 1.74 for the weekly chart. And VIX here also confirmed it. So on a weekly perspective, VIX is breaking bullish and TNX is breaking bullish. How about the dollar? About to break bullish, right? Off by 12 cents. So we now have the three things I don't want to see for us to be getting higher levels in the equity levels or the stock market. Pretty much all looking for golden crosses here. Oh, no. All right, moving forward to the DAX. The DAX actually looks a lot better. But what's important here is that it's bouncing off the 2018 and 2020 areas, just like the Russell. So if we're going to bounce, we want to see it actually not go back inside this pocket at roughly 14,000. If it does fall back below, it's almost inevitable that the S&P is not going to be able to shrug it off. Oil. Let's remove that move down to 0. Oh, let's actually not put it in a log. So there we go, right? We actually went briefly negative in oil. Remember that? I do. Oil here continues to be bullish, right? We see another strong lower wick, and it looks like it just wants more. Gold taking a leg down. So if you look here on a weekly chart for gold, I think this is actually a monthly chart. Huge cup and handle. And right now it is back testing those key relative highs going back to 2011. If we're not able to hold up this area, and I'm talking about roughly 1800 here, we're probably going to be heading back down to the relative lows and potentially down to the 50 monthly moving average between 1700 and 1600. BTC is below 30,000. This is not good. It's currently going down, and it is just battling to maintain these relative lows. Bitcoin is definitely a canary in the coal mine. If we're going to be getting more downside, I need to see it back above 30,000 for us to maintain a bull rally. Ethereum back below 2,000, and it's still above its 2021 lows we established in the summer and late spring, but it is below the 2022 lows, so that's a nasty cut. It's down 20% on the week. Briefly checking in on these trillion-dollar companies, Apple looks like it bounced off the previous level. Nasty cut though, right? Negative 6.5%. So we don't want to go back below 145 on a closing basis. And what's important to note here is that the green line, or the previous top, did not hold, and that's what led to the big decline. What were the warning signs? All these lower wicks. All these upper wicks here. Same thing that happened on the last time we dove down. So Apple actually having a lower wick now means that there is the potential for us to actually snap back. Microsoft lost its lower trend line, right? So it was respecting this lower trend, and it broke it inside of a head and shoulders pattern, which means we're still bearish. For us to reclaim this area, we got to get back above roughly 267 or the first relative low. Google, maintaining it, actually closing up on the week. Why travel? Google does a lot of travel, so it's maintaining its trend and actually closing up. Again, they're also doing a share buyback, so how much of that is Google buying back their stock? I don't know. Amazon, closing down 1.5 on the week, but putting in a hammer and closing higher than it did. Also looking here back to roughly 2260, which is where we closed, as the area we need to get to actually have a chance to shoot up to our 200 weekly moving average, which is right now here, that gray line, which corresponds with 2533. Tesla looks just like Apple. It lost its relative high, and it also lost the 50 MA. It's also down by double digits on the week, and I don't know what's going to happen with Twitter. Not here to speculate. Elon is just, I don't know what he's doing. Again, we have to think about, he was worth $250 billion, and if he lost 11% on his personal net worth, he's lost about $27 billion, and he's looking to put in about that exact same amount to buy out Twitter personally. So the amount he was going to spend to buy Twitter, he lost just this week. FaceTink looks like it might actually be looking for a little bit more, just like Amazon, just because it's been so oversold. And if the stocks that are the most oversold out of the trillion-dollar companies like Amazon and Tesla cannot bounce, how will the others? I do not know. Same is true for NVIDIA, hitting the lower part of its channel, and it looks like it wants to find a bounce area here. Have to get back above roughly 180 for the upside, and if we can get there, roughly 195 is going to be our trend line for next week. Moving forward to these ETFs, again, looking here at the Dow, it's been much more resilient than the S&P, as we noted, but it's now only reclaiming that first relative low, which means it's now back inside this yellow box, or the area where we've been spending the most time during the last 12 months. We're now at the lower part of the bound, so it's going to bounce back. I'd like to see some progress back up towards these highs, and we have to look for lows at 330, lows at 336, as the first areas where we're going to find supply or resistance. XLK looks a lot better than QQQ because there's not as much waiting for Tesla or for Amazon. And when we look back to here at XLK, it actually perfectly bounced off the high here and looks a lot more constructive. Still head and shoulders pattern, still below the 50, but more constructive than QQQ. The Russell, talked about it enough, bouncing off the previous support. ARK, talked about it as well. Bounced off the full puke, the washout. New York Stock Exchange, down by 2%. Again, right to that same low we're looking at for most of the other indexes. So we can note here that, we're just getting back to March 2021 lows, roughly a year ago. Equal weight S&P looks exactly the same, that same yellow box, getting back to March and April 2021 lows. Still ahead and shoulders as well. Volume is now ramping up. We can see that here by the volume increasing. XLF or financials. If we're going into an increasing rate environment, why can XLF no bounce? Why is TNX going down? It looks like the market is actually repricing, and financials are not catching a bid. It's below its April 2021 low. So if we're now seeing that we're going to be going higher in terms of inflation, this is a massive warning for me. Financials should not be struggling this much at all. Healthcare, bullish still, only down by about 1%, respecting the range. And I think that's because people need healthcare. They don't need the latest iPhone, but they need their medicine. Energy, cannot deny this is a bullish move either, right? Massive continuation here. Looks just like CL, very bullish, huge wick, and only down by about 2% of the week after a huge week last week. Utilities, looks like a pot and handle. And right now we are battling for that relative high, which goes back to 2020. The same area a lot of these other charts have already tested. So it's so important when we look at these areas that they hold, because if they don't, they're now going to become resistance. Emerging markets, dumpster fire. China is expected to, on Monday, announce more monetary easing because their country's just it's in peril, right? It's terrible over there. And then that's emerging markets. Then let's look at FXI, right? Look at that. China's stinky, right? Terrible. Huge megaphone lower. What are we putting in? Right? 2020 lows, 2018 lower low, 2019 lower low, and then 2022 even lower low. There are growth concerns in China, and we can clearly see that by us pointing right down to the dungeon. That is it for this week, so I really appreciate you watching. If you want to know more about my bear market of 2022 thesis, I encourage you to watch the video that will queue up here in a moment. Otherwise, I wish you all the best of luck, and please be prepared for the trading week ahead. Thank you for watching.